Hello everyone and welcome to SMB Capital. What I'm going to explain today is briefly trade in the Forex. But before I begin, I would like to thank everybody for viewing this video and also to let everybody know that we also approaching our deadline for our Forex training program here at SMB. This is a recent trade from 8/19, which is last Friday. We have a trade in the US dollar and Canadian. The small time frame is 15-minute chart. At the beginning of this trade, what we're going to identify first is levels of support using our Fibonacci retracements. So we take our Fibos from level 1, and since we had talked about levels of support being at 6.9% area, we see that the price has reached those levels. Once the price has reached that level once, and then comes back and reaches a second time without breaking those levels, the last price levels, the level of support, then we initiate a trade to the upside. The whole thing about this trade is the original stop loss. Original stop loss, since the price did not break the levels of support and the last lowest price level, then we can say that we can have a tight stop loss. Once it comes back, the price comes back down and breaks those levels, the last lowest price of the market, then we can say that we'll go on to the next support level. In this case, we had a tight stop loss. At this point, it was initial stop loss of 8.6 pips. So black Fibonacci level support, trade to the upside, finding a support entrance for a support trade, for a long trade. Also finding targets using other levels of Fibonacci retracements. So original stop of 8.6, so far 47 pips on this trade. So in other words, we risk less we expect in return. So in this trade, it was expected for more or less a 4 to 5 to 1 ratio for risk reward. These are the things that we find in our trades, especially in the Forex. We like to get at least 2 to 1. Many people confuse the risk reward differently, saying that the more you risk, the more returns you expect. But in this case, it's not completely true. We have a low risk and a high return on this trade. So like I said, every time we enter a trade in the Forex, we expect to get at least 2 to 1 on every trade. The higher the return and the lower the risk, even better for any investor. What you're going to be learning at Forex trading is the following: recognizing levels of support, resistance levels, also an entrance and entry level, of course, to enter any trade. At the same time, a stop loss, and also of course a target. A target will be dependent on the risk reward, as I mentioned before. And in regards to risk reward, you're gonna be expecting at least 2 to 1 ratio on depending on your stop loss. In this case, this is a tight stop, not even 10 pips, but it's also a short target of more or less about 50 pips. So in this case, the risk reward is basically on your advantage. Another decision in which involved the trade was correlations. More or less in intraday, what we expect from correlations regarding the US dollar and Canadian compared to the S&P 500 index is that its correlation is negative. So in other words, if we had a long trade in the US dollar and Canadian, it will mean that the S&P was actually going south towards the downside. So all those aspects are trained in our Forex trading, in which it will help you recognizing changes of market trend, depending on not just the pair that you are going to trade, but also other pairs that help to correlate it and help you make a decision at the time of trading. So again, I want to thank everybody for viewing this video, and our next video would consists of market correlations between one pair to the next, to the other pair, or to the index itself. Thank you and have a great day.